Welcome to TLD Talks, where we share insights about key legal and business matters that are impacting SMEs today. Bringing together experts from a range of backgrounds, we will be tackling the issues that matter to you. I'm Ed Simpson, CEO of the Legal Director, and today I'm joined by one of our very experienced lawyers, Rob Dunk, and Dave Eaton from accountancy firm Flinder. And we're going to be talking about share option schemes and in particular EMI options. By the end of the podcast, you'll have a good understanding of whether EMI options are right for your business, how to go about putting an EMI scheme in place, and the critical decisions and planning required before you do so. So welcome, Rob and Dave.
Thank you. Thanks, Ed.
And Dave, could I just ask you to introduce yourself and Flinder to our listeners, please?
Yeah, certainly. Flinder is an accounting consulting and data analytics business, and we specialise in providing a full suite finance function to high growth SMEs with a real focus on providing insightful reporting and an output to enable better decisions. Personally, I've worked as an FD CFO to young technology businesses for many years. Right now, I work as a portfolio CFO, so I work with a number of young businesses with a focus of bringing a level of financial expertise and scrutiny to the management team in the boardroom.
Great, thanks, Dave. So as I said, today we're talking about share option schemes, sometimes known as equity-based incentive schemes. And by that, we mean a way of enabling a business to offer its employees a way of participating in the equity of that business by giving them options to acquire some shares in the future at a price determined today. So why might a business be considering implementing such a scheme?
I guess there are a multitude of different reasons, and certainly in the clients that we come across, there are a variety of different reasons as to why they're doing it. I guess remuneration is one of them. Sometimes the companies don't have enough to offer a fully cash-based remuneration program, and some form of incentive through share options is an alternative way of bridging a sort of financial gap. I guess the other thing is just the sense of incentivizing employees to be part of the growth of the business at a tax incentive driven basis. It allows incentivizing employees to be part of the growth of the business and for them to realize and participate in the value creation that they're responsible for.
Yeah, I think the only thing I'd add to that was EMI schemes are geared towards smaller companies and a lot of founders are building towards some kind of exit. Investors are obviously have the same priorities, and this EMI scheme aligns everyone's interests, so employees are then incentivized to work towards that same goal.
Okay, so if you could imagine yourself being approached by the CEO or founder of an SME who's saying, I've heard about EMI option schemes, it sounds like the right sort of thing for me. What sort of planning would you advise that CEO, that founder to do? What sort of things do they need to be thinking about before embarking on this?
So my first question and discussion is always, why are you putting in place an option scheme? What are you trying to achieve? Is it to align all employees to an exit? Is it to create shareholders in the business? Is it to put in place specific performance measures that you can reward employees for without the need for big cash outlays?
In connection with that, there is a point that EMI schemes, while very flexible and very favourable, and they've got some great advantages, they may not actually be right. So I suppose before we get into a discussion with the client as to EMI and how to structure them, there ought to be maybe a more general discussion around whether EMI is the right route to follow, because sometimes it's about participation in the business, actually being shareholders, and actually EMI options are options and they tend to be exercised at a future stage. It's not about getting employees into the business through a share participation program, and there may be other routes that may be more appropriate for the company and what they're seeking to achieve. So we've got one client at the moment that's come to us after they've gone down a EMI online type route and have actually thought about it further and realised that actually what they're looking to achieve is simple share participation in the company. And an EMI option is probably not the right route for them to follow.
What does a business need to be thinking about before embarking on the process?
I guess from a legal perspective, one of the points that a company may have to consider before doing so, and we might touch on later on in this podcast, some of the criteria that a company needs to meet, but some of those criteria mean that the company may have to actually implement structural changes to their business before doing so. So they may have to change some of their share class structures. They may have to move around some share ownership within the business. they may actually need to think about the way the group is structured because of some of the detailed requirements about subsidiaries and ownership and position within a group, etc. So there may actually be some fundamental work that the company needs to do to align itself with some of the requirements of an EMI program in the first place.
Many of our listeners and many SME owners and managers will have heard of EMI schemes. What is it about them that makes them so popular?
The main thing that everybody thinks about is that they are hugely tax efficient. We'll probably go into the details of the tax savings a little later, but they are very, very tax efficient for both the company and the individuals benefiting from them. They are widely available. There are parameters you need to be within in order to qualify as an EMI eligible company, but they are fairly broad. It is available to most SMEs. The employees can understand the benefit they're getting. Actually, they're relatively easy to implement, and the administration is fairly light touch on an ongoing basis.
Okay, so just picking up on a couple of those, Dave, the first point you mentioned was tax efficiency. What do you actually mean by that? What does tax efficiency mean in practical terms?
So I think there's tax efficiency from two standpoints, from the individual's perspective and the company's perspective. From the individual's perspective, ultimately, if the scheme is working as we intend it to and all of the benefits are achieved, the employee effectively pays a tax rate of 10% on the gain they make. The gain here is the difference between the price that is agreed when the options are granted, the price they're actually buying the shares for, and the price they ultimately sell those shares for. When that sort of a value event is realised, the tax position is a 10% charge rather than potentially 45% charge. There is another consideration from the employee's perspective, and this is to do with the timing of when tax would be paid. There are three kind of data points on an option. We grant the option, that's a piece of paper. We exercise the option, that's actually buying the shares. Again, that's a piece of paper. And then the shares are sold. Very often, those final two pieces happen at the same time. Not always. And if it's in a non-EMI option scheme, then those employees would actually have a tax charge when they exercised their options and bought their shares. So not only would they have to shell out to buy the shares at the exercise price that's been agreed, if that price is lower than the price at the time they buy them, there's also a tax charge then on a non-EMI scheme. And so that means these employees have to shell out to buy the shares and for a tax bill, and they haven't received any benefit yet. They're still just holding their piece of paper.
Okay, because they haven't sold the shares at that point.
Absolutely, yeah. Probably worth just touching on the company's perspective as well. So from a tax perspective, simple things like the cost of setting up the scheme would be deductible for corporation tax. So that's an offsetting expense. The other thing to consider, I suppose, is an EMI option is ultimately part of a remuneration package. Well, firstly, there's no cash going out of the door on day one, but also there's no national insurance to pay. So you're saving your 14% national insurance on that. And the final bit that is often actually overlooked is that there is a corporation tax deduction when the exercise happens on the difference between the value on exercise and the gain that the employees are making. If it's a scheme whereby it all happens at the exit, potentially the current business owners don't actually benefit from that corporation tax deduction because it's for the new owners. But it can be a very useful kind of bargaining chip on the working capital adjustment or anything like that. So there is that potential corporation tax offset that is absolutely there to be used.
Okay, so that's pretty clear. This is a way of potentially delivering significant value to employees at a very low tax cost. You talked a couple of times already about EMI schemes being flexible. What does that mean in this context?
So the company needs to fit in certain guidelines to be eligible. But once that's the case, we do have a huge amount of flexibility in terms of who we can grant options to, how much we can grant, what behaviours we want to drive with those options. So to give an example, a number of schemes are set up such that these options can only be exercised on a sale event. But the behaviour we're trying to drive there says we want our employees to stay with us and drive growth until we exit the business. Another option, a company I've been working with recently, we put an option pool in place. And what that was designed to do was to drive certain behaviours annually. So we put in place very strict performance criteria. And if they met those performance criteria, they were granted a certain amount of options or a certain amount of options vested at the end of that year. And we put that in place for 3 years. This company doesn't have huge cash reserves, so we didn't want to put big bonuses in place because we didn't have the ability to do that. But what we could do is grant options and drive the behaviours we were trying to achieve by putting those really specific performance criteria in place.
That brings up one point which we may come to, but it's worth raising at this point, of course, is that, what Dave highlighted there was the ability to create some kind of almost deferred bonus scheme, that bonuses are effectively paid out based on current performance, but they only really realize that bonus, if you like, at a sale event or at a later stage, or if they decide to exercise those options. I suppose the thing that the employees in particular have got to be mindful of is that for their continued participation, they do need to remain an employee. I mean, it is an employee incentive scheme. And the moment they cease to become an employee for whatever reason, and this is one of the inflexibilities of the scheme. And I think Dave's absolutely right when we talk about the vast flexibility within the scheme generally. But one of the inflexible aspects of it is that it does require ongoing employment. And if they were to leave at some point before they've exercised the options or before that triggering event has taken place, they will lose their beneficial tax rights in relation to those options. So it's good, but it may have a bit of a sting in the tail if those individuals, for whatever reason, good or bad, leave the company.
Yeah. What rules do we want to put in place for leaving employees? Because as Will brightly says, if you leave employment, you cease to benefit from those tax incentives. But there are means by which employees can still exercise their options and benefit from the tax status. What we tend to put into the language of the schemes is that ultimately that becomes a decision for the board. Would all boards want every employee to be able to exercise their options? And then you've got a huge number of really small shareholders and who have left the business. So another element of that flexibility is those kind of mechanics.
Yeah, agreed. I think this is why there does need to be a discussion between us on both sides and the customer or the client as to exactly what they're trying to achieve. And sometimes when we sit down with the clients and have that discussion, it's actually something that they haven't really thought through either. Some of the detailed consequences.
Yeah, I'm glad that you raised that point about leavers, employees with EMI options leaving the business, because it's probably the question I am asked most. It's the one that arises almost when it's too late. So an employee who has EMI options is leaving for whatever reason, and nobody's quite sure what the position is. So that's a useful point to have made.
I'm working with a client at the moment who has 2 employees who are leaving, who have been promised EMI options, but nothing has ever been put in place. Now, these were promised 3 years ago. So this opens up a whole can of worms. They were effectively promised these options at a price. That price is no longer valid because that was 3 years ago. The company is significantly more valuable now. So we are having to grant those options as of today's date at a significantly higher price to retain that tax advantageous status. Leaving employment is often a trigger to uncover a whole heap of stuff that wasn't done way back.
Well, a really good example to underline how important it is to have taken proper advice and done all the thinking and the planning before making promises or before starting to implement a scheme and getting all the timing of the various components lined up as well.
Yeah, which I suppose does pick up a point that I think we have addressed, but it's worth stating it again. There are great flexibilities within the scheme, but one of the certain inflexibilities, if you can call it that, is the fact that you have to peg it at a value that's based on a value to be agreed with HMRC. So that aspect, both from a timing perspective and a valuation perspective, you do have your arms and legs tied a little bit as to what you can do. So to pick up Dave's example, promising this to employees when you try and onboard them or bring them into the company, and then push on into the long grass the implementation of the scheme rules and the issuing of the option agreements can trip you up later down the line if you leave it. I suppose the other point to pick up on that is they are options over a number of shares. They're not necessarily options over a percentage in the company. And often we've found that employees, as part of their being brought on board to the company, have been promised a certain percentage in the company. You will own X percent. And the reality is options are over a number of shares. And as these companies grow, particularly in the ones that we deal with, they go through investment rounds, there are dilutions, et cetera, which, there is a big distinction between the number of option shares and the percentage you will own in the company.
So the other issue that is worth mentioning here as well is I've seen cases where employees have been promised options with a particular value. So you will have options equal to your current salary, which also can cause some issues, especially if the administration isn't particularly efficient and the options aren't granted straight away. But it does bring me onto this whole issue of valuation. It's probably the other question I'm asked most often is around valuations and how the valuation piece is done, whether it needs to be agreed with HMRC and how sophisticated the valuation process needs to be. Dave, if you could comment on that, you're obviously the expert in this area.
So to answer the first question, does it need to be agreed with HMRC? I mean, technically the answer to that is no, but I would never advise anybody not to agree the valuation with HMRC before granting options. It closes off any potential risk and loophole there. So in my mind, it's a no-brainer. That they have a mechanism that's very simple. There's a specific form for doing so. In terms of the process and how in-depth it needs to be, does this need to be a 20-page valuation document with MPV, IRR calculations? Absolutely not. We're not trying to value the business for potential sales, those kinds of things. I don't want to undervalue what's needed and say it's a tick box exercise, but there is an element of what we're trying to do is just make sure we've got our ducks in a row before granting any options. What I would say is going through the process, most of the companies who are putting in place EMI options are young companies. This is most, not all. A lot of them are loss-making. Some are pre-revenue for a really early stage. So there's no benefit in us doing the sort of traditional multiples of revenue, multiples of EBITDA, those kinds of things, because a lot of those numbers are negative. I have a fairly standard formula, pin the valuation to the most recent third-party fundraise or third-party share transaction and apply a discount from that. It's realistic. We have a third party that has purchased shares on that basis. And the discount is an interesting point. 5 years ago, say, you would have taken that value, you'd have applied a 95% discount on it, and it would have been signed off by HMRC. That was just the norm. That's changed slightly. I took that broad approach a few years back and was rejected. So I spoke to the revenue about it and they said, yeah, their guidance has changed and it needs to be a more justified valuation and justified discount, which is not unreasonable. You can still get discounts of 70, 80% from those valuations, provided there's justification to do so. Now, what that justification might be that an investment round was on a preferred share. These might be ordinary shares or even a less preferable share type that doesn't have voting rights, doesn't have dividend rights, etc. So that difference between the share class is absolutely justification for a discount. So I tend to start at that point and then just layer in sensible arguments for a discount. And that normally is relatively successful. If it is a more established trading business, again, I'm not going into huge detail, but I will take perhaps 2 or 3 valuation methods, the assets of the business, the most recent share round, multiples of revenue if it's relevant for a particular industry, and then probably take an average of those. As long as you can demonstrate you've put some thought into the process, it's realistic and it's reasonable, HMRC generally accept them.
Okay, so obviously it's in everybody's interests with the valuation for EMI purposes to get that valuation as low as possible so that the employees are exposed to the maximum gain. Having implemented an EMI scheme, got a relatively low valuation, is that going to create a problem in a future funding round when you're looking at external investors putting money into the business, where obviously you're, as the owner of the business, your interest then is to get the valuation as high as possible? Or do investors kind of know what the game is?
That's a really good question, something I get asked a lot. When I send the valuation letters that I write to business owners, I often sort of send it with the caveat that you mustn't take any of this personally, because it's not a positive outlook on the business. The reason for writing that, as you say, is to get as low a valuation as possible. The pitch deck might say we're going to suddenly do 100 million of revenue next year. My evaluation letter will say we've got significant costs to incur to get there, lots of losses to make, and the business is very uncertain. So very different. But to answer your question on whether investors know the difference between those two, absolutely. What I would always try and do on those valuations with HMRC is just be really factual. This was the last valuation investment round. These are the reasons I'm applying a discount, and that's the discount I want. Investors will see that and understand the rationale for those arguments.
So HMRC are generally open to those arguments around discounting, getting the lower valuation, but in most cases that's not going to create a problem for yourself in the future when you're looking at investment rounds.
No, absolutely. I think they're very different things.
Great. Okay, moving on to what some people might see as a little bit more boring, but totally essential part of this is the sort of the admin and the paperwork involved. Rob, if you could just give us a brief overview of what's a business that puts an EMI scheme in place going to be faced with.
Well, I suppose first, before they do so, before they rush to do it, they need to make sure that they qualify. And I guess they qualify as a company, but also that the employees or the people that they're looking to award those to would also be qualifying, because I think there's both qualifying from a company perspective and an employee perspective. There are some criteria that are set down by HMRC: assets not exceeding 30 million, no more than 250 employees. They must be a small business in a sense, a small, medium-sized business. There are some requirements about their group structure. I don't think that's relevant really for this call, but there are some qualifying criteria from the company's perspective, and most of our clients are well within that. For the employees, I guess there's just another qualifying criteria that they need to be genuine employees in the sense that they need to be working sort of full-time or near enough. The consequence of that is that it precludes consultants and non-exec directors. So again, that must be borne in mind if a lot of your workforce are consultants because of the nature of your business, or you want to also remunerate your non-exec directors as part of what they're doing to help establish and grow the business. Assuming that you're comfortable with that, or you've got past that, we then need to look at, going back to your actual question, Ed, the administration side. So typically there will be a set of scheme rules, and that's something that Dave and I will work together with the client to put in place and go through a lot of that questioning as to some of the detailed administrative and consequential requirements of people leaving employment, people dying, etc., board discretion to vary some of the requirements, etc. So there's a set of scheme rules. And then on an individual basis, there will be an option agreement, which effectively gives that individual their own individualized amount of share options. And as Dave said at the beginning, setting out the flexibility or the individual nature of what that individual employee needs to do, whether it's performance criteria or whether it's time in employment, those kind of criteria or incentivization programs that are linked to that employee. So it's in that option agreement that those are typically set out. There are some compliance obligations after that. Filings and the like then need to be done once those share options are granted, and some annual filings thereafter. But that in a nutshell is the package of suite of documentation that needs to be put in place.
The grant of options is an administrative process. There is a valuation that normally needs to happen. Those agreements need to be put in place, so names and numbers, etc. I would always advise people not to grant as soon as an employee joins employment. I always advise we have a maximum of 2 granting windows in a year. When an employee joins, you say, yep, you're entitled to this number of options, and they will be granted in our June window, and then we have a December window, something like that. Just to take the administrative burden away. And there's obviously costs involved in going to get valuations and those kinds of things.
So each time you grant options, you technically need to go through that valuation process again.
That's right. I mean, the valuation will last for normally 90 days unless something's happened that you need to tell HMRC about. But if that window has closed, then yes, absolutely.
So we've talked about setup and documentation. We talked about valuation. This sounds like it could be expensive. SMEs, will be looking to preserve their cash to sort of focus on their business strategy. Can you give me an idea of what sort of costs would be involved?
Yeah, sure. We obviously it depends who you use and how you run the scheme, but we have a solution. There's an upfront cost, of course there is. We've got to draft some fairly chunky documents to put the scheme in place and do the administration early on. So there is a cost of a few £1,000s to do that. There is an ongoing cost to do the administration. This is hundreds to a couple of £1,000s a year.
Okay. And for those businesses that are really looking to save costs, I'm aware that there's a lot of online resources, as with a number of areas. EMI schemes is no different. A lot of online resources, template, scheme rules, template, grant documents available for free. Is this something that a business could do itself?
From my experience, yes, they can do. And I think there are some good systems and templates out there available. I suppose my only caveat in relation to all of that is that we do have a number of clients that come to us after that with a lot of questions and a lot of things that they haven't thought through. It's not quite as easy as they thought it was going to be. They are worth considering with a cautionary note, I guess.
Okay, so from the discussion, it sounds like there are a number of tripwires out there that it would be quite easy to stumble over if you're not particularly experienced in putting these sorts of schemes in place. Okay, so just rounding things out, we've been talking about EMI schemes. Dave, you mentioned earlier non-tax advantaged options. We touched on some of the parameters that businesses need to be in, and obviously not all businesses qualify, and certainly not all employees or workers would qualify for EMI. So if a business wasn't able to take advantage of EMI, are there viable alternatives?
Yeah, there are certainly Lots of alternatives. A more vanilla option scheme is certainly out there, so that runs exactly the same way as an EMI scheme. It's just how the individuals are taxed on those. The disadvantage with that is it's taxed as income, and it's taxed at a slightly different point, as I mentioned earlier. So there's the potential that there's a tax charge with no cash receipt, and also up to 45% tax charge, very different to 10%. We worked with a business not that long ago who almost exclusively their workers are contractors, consultants, self-employed. So therefore, the EMI option is not possible. The non-tax advantageous options were not particularly attractive, so the growth shares was an option there. And a growth share effectively creates a new class of share that have no value on a sale until the enterprise value reaches a certain point, or the share value reaches a certain point. The difficulty with that is that you are actually granting shares on day one to those individuals. So should they leave and they're not employees, should they leave, you have to get them back. That's not without its challenges. You have to put strict rules in place there. That creates work and creates cost, obviously. So it's a more complex arrangement.
To pick up on that point, stated the obvious, but I think it's an important point. These are options. They're not actually shares. And until such time as the option is exercised, you as the employee, you're not a shareholder in the company. Now, that has consequences, potentially positive and negative. Sometimes people confuse that subtle distinction between being a shareholder and being an option holder. You're not involved in the participation of the company. You're not a shareholder. You're not entitled to dividends. You have an opportunity at a future stage to be able to convert that option into shares. But yeah, as you said, Dave, there are other options out there, including looking fundamentally at just options around share participation and flexible options within that a company should think about. And going back to that fundamental thing about planning and about identifying what you're trying to achieve from this whole program of incentivization and participation, because that's fundamentally what it all comes down to.
Thanks, Rob. Wrapping things up, could I ask you to summarize your key takeaways for any business owner that's considering implementing an equity-based incentive scheme?
My sort of concluding statement would be there is flexibility, and things like the valuation window, whilst again gives you a degree of flexibility to work within it, 90 days actually can go quite quickly. And so I think there is a degree of planning around the administration of this and your decision making around performance criteria and things that just need a bit of upfront planning. Do that planning upfront.
Dave, anything to add?
Think through what you're trying to achieve before communicating with employees in detail. Do all that planning, understand what you want from the scheme, and then tell employees what you're going to be offering them. You mentioned it earlier, Rob. I always say talk in numbers of shares, not percentages, because that can only have a negative impact when percentages go down. And then finally, just don't forget the compliance. Not a company I was involved with, but a legal firm in a transaction I was in a while ago told me a story that they had forgotten to do all of their in-year grants for EMI options. So there were a lot of employees whose options were therefore not EMI options and taxed as income. The business owner, it was an owner-managed business, he ended up effectively footing the bill for that, but that went into the millions. So don't forget the compliance.
That brings us to the end of the podcast. Thank you for listening. If you enjoyed our discussion today, you can subscribe to our monthly TLD talks covering a wide range of legal and management topics. You'll find details on our website, www.thelegaldirector.co.uk, and you can also find us on Apple, Spotify and Google. If you'd like to know more about EMI schemes and other equity-based incentive schemes, or indeed the wider work of the Legal Director, then do give us a call on 020 3053 8613 or visit our website.